Have you ever wondered what in the world is a hedge fund? And why do we hear about them in the news from time to time? Well, if that is something that interests you, stay tuned. I have some answers for you. Hedge funds are then an alternative investment. Now, probably most of you watching this video, it's not necessarily an alternative for you. Okay, sorry to tell you, because there's pretty high requirements to get into one of these hedge funds. But they use pooled funds. They take some money from you, if you could do that. They take some money from the famous actors and actresses in Hollywood. They take it from rich people, and they put all that money together, and they try to implement different strategies to earn attractive returns. Okay, that's what a hedge fund does. I want to make you some money, man. And I got this secret way of doing it. So give me like $10 million and I'll go do it for you. That's really what a hedge fund does. So hedge funds may be very aggressively managed. Man, they're out there, they're doing anything and everything to try to make that return. They can make use of a thing called derivatives, which means it's an instrument that we trade that derives its value from something else, like an option, okay? Or credit spreads and swaps and things that okay, that can be kind of complicated and even more difficult to understand. They also can use leverage. You use leverage now if you have a margin account. You might put $10,000 into your account, but that gives you $20,000 of buying power. You just borrowed $10,000 and that's leverage at that point. Or they can use futures contracts, which have an even greater amount of leverage attached to them. With some futures contracts, just as an example, you might put up $1,000, but the asset that you're controlling might be worth $100,000. So that's great if everything goes the way you think it will. That can be really bad if it goes the way that you hope it won't, because the losses can mount up very quickly. Some of these hedge funds, they're active in both the domestic markets inside the US or in international markets. They might invest in China or Japan or Germany or South America, or they're constantly out there looking for something to give them an edge over the rest of the market. And so they're just looking for anything to get a good return on their investment. So hedge funds are generally only accessible to what we call accredited investors, since they require less SEC regulations. There used to be no regulation on these guys. They could just go crazy. And a lot of politicians are involved in hedge funds, so that's kind of why there's not many rules there until they themselves personally get burned. Then you're going to see the rules start flying. Okay? So be aware of that. And then you might use a thing called mutual funds, which are similar in that it takes pooled money, but there's a lot more rules with mutual funds. They're more restricted in what they can do. If a mutual fund, first of all, they usually only go long. There are exceptions, but they usually only go long. And then if you have an IT mutual fund, they can't go invest in a pharmaceutical company or buy real estate in Colombia. Okay, or look at this next AI thing in China. Okay, maybe you have an IT mutual fund that only invests in American companies. They can't go outside of that. Where a hedge fund, yeah, this is what we're doing. Is it okay if I do it? Sure. They have a mandate and they kind of tell you what they're going to do, but it usually gives them a lot of leeway to do whatever they want. It's like, I don't care. Show me the money. That's really all these investors care about. They just want the returns. They don't care how it happens. Okay. Some of the goals for hedge funds, they're designed to take advantage of certain market opportunities. For example, they can go long. If they think something is a really good stock, they may buy a lot of that stock, hoping to sell that stock in the future. They may go short, which is kind of what we're talking about today, or both at the same time, not necessarily on the same stock, although they could do that using different types of instruments. They could be long and short at the same time to kind of hedge themselves, okay, or protect themselves. But a lot of hedge funds don't practice hedging, which is kind of interesting. They got the name. All right, so hedge funds use different investment strategies and are often classified according to an investment method. Now we have these hedge fund managers who are like rock stars. If they have good returns for their people, man, they eat in the nicest restaurants, they have private planes, they get Super Bowl tickets for $1. I mean, just anything, all these different perks can happen for them. So this can be set up by the hedge fund manager, which the investors then, it's like, hey, Joe has this hedge fund and he's been really good and he's a real rock star in the investment world. Okay, so I'm going to put my money into that. Well, at one time, the name Bernie Madoff had a pretty good reputation where he made off with a whole lot of people's money. And so sometimes you're investing in a name rather than an actual investment. You like the manager. There is substantial diversity in risk and investing methods. Some of these hedge funds are pretty conservative and they're not going to go too far off the grid as far as their strategies. Others are going to be very aggressive. So just be aware of that in the different kinds of investing that they do. It's like selling your pumpkin futures after Halloween, like Homer. Okay, some hedge funds are very conservative while others are very aggressive. Legally, hedge funds are most often set up as a private investment limited partnership. So you can't go after the manager himself. He's protected, or she is protected. That's a limited partnership. And limited means they're limited in their liability. So if they lose your money, you can't necessarily go after them very easily personally. You can go after the hedge fund, but you can't go after them necessarily unless they break the law and end up going to jail for a long time, like some have done. And they're usually open only to a limited number of investors. Okay, we're opening for 1,000 people right now. And they require a large initial minimum investment. It could be $10 million or $2 million or something like that just to get involved. You can see why a lot of you are probably not in these hedge funds. Investments in hedge funds are usually illiquid because they often require the investors to keep their money in the fund for a specified period of time. And one of the things that I teach in my classes is liquidity is a huge, important factor. If you want to get in, you want to get in right now. If you want to get out, you want to get out right now. You don't want to have to wait for 30 days or 60 days or 3 years before you can actually get out. Well, the hedge funds, they need your money in there. They don't want to have a run on the hedge fund where everybody's calling up really quick and trying to get all their money out at the same time, just like in It's a Wonderful Life. And then the hedge fund has $1 at the end of the day and they're all dancing to the vault. Okay, they don't want to have something like that happen. So they might say, if you give your money to us, your $10 million, you're going to have to keep it in here for 3 years before you can plan on taking it out. That buys them a little time to do what they want to do, but it also hides them for a period of time so that if something weird is going on, you might not find out about it for a while. So withdrawals may only happen at certain intervals, such as maybe every quarter, or even maybe twice a year, biannually. So some of the characteristics of these hedge funds are the SEC, the Securities and Exchange Commission, states that hedge funds are only open to qualified or accredited investors. And this is their definition of an accredited investor. You have to have an annual income of over $200,000 over the last 2 years. Now, if you went through 2020, you may not meet that requirement. And I'm not trying to be funny about that. It's a reality. It's a reality of what's going on right now. Where some people did very well, where others are really suffering right now. Or you have to have a net worth of over $1 million. And that can't include your house, where you live. It might be another house. It might be a rental property or something like that. But you have to have a net worth of over $1 million. And then these investors are deemed suitable to handle the potential risks. Okay, I know a lot of very wealthy people that really aren't all that smart, but they would fit being an accredited investor. They might be very well versed in their own occupation, but they may not really understand the stock market. That's the interesting thing about the stock market. You have doctors, lawyers, teachers, professors, scientists who are very, very successful in that field, who are just absolute failures when it comes to the stock market, because it's a different game. You have to think differently. It's a different mental process that you go through in the stock market. And there's so much that's out of your control. So where you might be in a profession where you control what goes on, like as a teacher, I can control what happens. I can control what I teach, how I say it, and what I'm going to talk about and what I'm not going to talk about. In the stock market, there's a lot of things happening that nobody can really control. Then a hedge fund's investment method is only limited by its mandate. Okay, they may tell you, well, we invest in real estate in various areas of the world and stocks that are poised to go up, and we also look at stocks that are poised to go down. I mean, that's very general right there. So they could pretty much do anything they want at that point. A hedge fund can basically invest in anything: land, real estate, there is a difference, stocks, derivatives, these are like options and swaps, credit swaps, and all these kinds of things. If you want to learn more about that, watch the movie The Big Short or read the book. Or different currencies. There's currencies, the euro against the dollar against the Swiss franc. A lot of hedge funds take part in that. Mutual funds, which is more likely what you are involved in, it's more for the common person that doesn't, because you can open some mutual funds for $50 and it doesn't take a lot of accreditation to become part of a mutual fund. Now some do, but a lot of them don't. A mutual fund has to follow a thing called the prospectus, and that's the laws of that mutual fund. And they typically only go into long positions, and they can't go outside of what the prospectus says. Where a hedge fund, they can pretty much do whatever they want. If they tried to tell you in a way so that they don't take any blame themselves, but say, look, I told you this is what I could do, and so how come you're coming after me? Yeah. See, they always leave themselves an out. So hedge funds can often use leverage or borrowed money to get better returns. Hey, if you could buy $20,000 worth of stock and it doubles, that's a much greater return than if you bought $10,000 worth of that stock and then it doubled. Makes sense, as long as you're right, but it can really be bad if you're wrong. So the fee structure, and this is the part that'll get some people. Instead of charging an expense ratio, that's what mutual funds do. And you can go to websites and they have lists and you can compare the expensive mutual funds with the not really expensive ones. Hedge funds charge both an expense ratio and a performance fee. Typically a 2% asset management fee. And then if they make any money, they get to keep 20% of any gains. Now, some people have no problem with that. It's like, hey, if you're going to earn me some money, I'm cool if you earn money too. There's no problem there. Hedge funds can pretty much do anything as long as it's disclosed to the investors. Sometimes this is after the fact, though. So you might not hear about this until months later. Now, sometimes you might be more in the know with what's going on and actually see what's happening at that time. But sometimes you may happen way after the damage has already been done. So this can be very risky with some of these hedge funds. It's great when you're showing them the money. It's not very great when you're taking the money away. Some huge failures have involved hedge funds. We saw this a lot in the 2008 meltdown. A lot of hedge funds went belly up at that time, but other hedge funds have also produced some fantastic returns. So there are good and bad when you're looking at these things. If you're listening to this and you are in hedge funds or you're looking to get into one, I'm not here to bash them. I'm just saying they're beyond the scope of most everyday American and even non-American investors. And if you're looking at doing this, just do your research. Don't just go off of what somebody says. Dig in and find out as much as you can. It's your money on the line. Put as much effort into your investments as you are your next vacation, which you won't be able to go on because of travel restrictions. So look at this and really try to make the best decisions that you can. So why is it called a hedge fund? Hedging is the practice of attempting to reduce risk. So we have insurance, car insurance, house insurance, renter's insurance, health insurance. These cover those costs if something goes wrong. We're hedging when we buy insurance. But a lot of these hedge funds, they're not doing that necessarily. But it's just a name that they came up with and it's stuck. But it might have something completely different than actual hedging or protection. However, most hedge funds try to maximize returns. That's what they want to do. They want to be rock star hedge fund managers. So the name hedge fund is mostly traditional and does not accurately describe what most hedge funds do. We just call them that. Hedge funds can use dozens of different strategies all at the same time, and they may not even implement hedging. Just so you know, in my classes, I teach hedging so that you can protect what you already have, maybe as far as gains, or you can protect your investment. Now, it's going to bite into your returns, but at least when things go against you, you're going to break even or come close to breaking even. A lot of these hedge funds don't even do that. They're just flying money out the door, just certain that they're going to see a good return, so they don't worry about any protection or hedging. Some hedge funds are very risky and speculative. Okay, so what are some of the risks? Certain investment strategies expose hedge funds to potentially huge losses. Hedge funds typically require investors to invest money for a period of years. So even if you put your money into one of these and you want to get it out, good luck. You watch Boiler Room. There's a movie about this where you could sell whatever you wanted to sell to people, but you're not going to let them buy it back from you no matter what. And be aware of those things. So the use of leverage or borrowed money can lead to significant losses. Then the methods that work during certain periods, well, it worked a year ago. They may not work now. The markets are changing, the moods of the markets. Now, it's still buy and sell, bid, ask, but there are different things that the market becomes obsessed with and focuses on those things. And so a strategy that you implemented at one point may not be effective at another point in time. Some hedge funds have participated in illegal activities. Imagine that. Such as insider trading. Now, there's a legal kind of insider trading, and then there's an illegal kind of insider trading. We're talking about the illegal kind. Just as an example, let's say I owned a publicly traded company. And it's a pharmaceutical company, and I go golfing one day. I love to golf. And I meet you, and we're out on, you've never met me before, or maybe we are friends. Maybe you just were acquaintances, and we're out, I'm my usual under par self. Actually, I'm happy if I can shoot a bogey round, but anyway. And we're on the putting green one day, and I'm like, hey, by the way, that we got this drug, this COVID-19 vaccine, and we got the test results back, and it looks pretty good, so you might want to buy some of our stock. Now, what I just did is illegal. I shared private information with you that's not available to the public, and that is called insider trading, when you're acting on information that is not available to the public. See the movie, the first Wall Street movie. That's why at the end of the movie, Bud goes to jail. It's for insider trading. And that's what got him in trouble. And eventually Gecko gets in trouble for the same reason. Not the Geico gecko, but Geico the investor. So the pay structure, hedge fund managers typically require a fee of 2% of their assets under management and 20% of the profits. Okay? Well, what happens if they have a losing year? Even if the hedge fund loses money, the manager will still receive 2% of the assets. Wow. Do you like that? Maybe you don't have a problem with that. That's a part of doing business. You got to spend money to make money if you want to have a good manager. Some of you might see that as very unfair. You have to decide. For example, let's say a manager oversees $1 billion. They could earn $20 million that year without doing anything. They could just keep it all in cash. And they don't lose money, they don't make money, but they're still going to earn $1 billion that year based on that 2% management fee. There have been different fee limitations known as high water marks to prevent hedge fund managers from getting paid on the same returns twice. And believe it or not, there were ways that, like double taxation. Well, this was a way for double payment. There may also be fee caps to help prevent managers from taking on excess risk. So some hedge funds implement this, others don't. So the future of hedge funds, some of these controversies that have surrounded hedge funds include insider trading, which I talked about. That has happened and people have gone to prison because of that. Tax avoidance. Some of these are set up offshore, and so they get very favorable tax rates depending on where they set these up. Some of you don't have a problem with that. Others say, I only want an American-based hedge fund. That's up to you. Management overpayment, which I kind of just alluded to, which you may not see as overpayment at all. As long as you show me the money, I don't care what you make. That may be your attitude. Others may be, wait a minute, this guy's still going to get paid even if I don't make any money this year or if I lose money? Some of you might have a problem with that. A lack of regulation. Because these hedge funds have billions and billions, I feel like Carl Sagan, billions and billions of dollars. And so they carry a lot of power with them. They donate not only to the Republican Party, but to the Democratic Party too. So they have friends on both sides. So they want to be in the best shape possible for themselves, no matter who is in control of the government. That's why a lot of times you see a real disconnect between what's happening on Wall Street and what's happening in Washington, D.C. Because Wall Street generally sees Washington, D.C. as little more than theater. There's just a bunch of yahoos yelling and screaming and not really doing anything. They're trying to base what they're doing on other logic that doesn't include what the politicians are doing. Now, that did change under President Trump with a lot of the tariffs and a lot of the regulations that he made go away and things like that. But they did not necessarily have a longer term impact on things. Things like Brexit, the 2016 election. Yeah, the markets reacted to that, but quickly recovered and kept doing what it was doing before. So you have these short-term reactions and then the longer-term trend that usually the markets will go back to. So this has led the SEC and the Congress to consider new regulations for hedge funds. Well, some of these hedge funds have a lot of senators and representatives as friends, if not sons of presidents. Okay? And so some of these regulations might not really be all that helpful to you. It might be beneficial to others instead. Then hedge fund advertising rules. They can't go out and say, yeah, last year, man, we got 150% return. Come here. It's only a $10 million minimum. If these guys are so good, they're probably not going to have to do any advertising anyway, because word of mouth is going to spread through the elites, and they're just going to magically flock to these hedge funds anyway. Then some changes have been slow because many hedge funds have a lot of money, power, and influence. Not only on one side or the other. They influence both Democrats and Republicans, no matter who's in charge or in office. Okay, when you're looking at the markets, there's a thing called smart money. The stock market typically puts all investors into one of two categories. First of all, the smart money. This could include institutional investors, the central banks like the Fed, Bank of Japan, the European central banks, pension funds, that control Orange County, if some of you remember that, or different retirement plans for your company. And believe it or not, some of these pension funds do invest in hedge funds. Did you know that? You might want to check into that. This may actually bleed through and affect some of you personally when everything is said and done. That's just speculation on my part. I don't know if that's actually true. It will depend on how things play out. And there are some really, really good financial professionals out there that are worth billions of dollars who are considered the smart money. They've spent their lives doing this and they get very good at it, and they're also very wealthy. So then you have the dumb money, and that is pretty much everybody else. And that can include some of the hedge funds. Just because they have a lot of money doesn't mean they're necessarily the smart money. So many individual investors, traders, and hedge funds may be big money, lots, show me the money, but they may not be smart money. The challenge, and this is what I do every day when I'm following things, this is the challenge that I have, is trying to determine which is which. If we see a big trade go through, is that smart money or is that just big money that's not very smart? So when you see a huge trade, it might look like the smart money is actually doing something when in actuality, it's just the dumb money doing something on a bigger scale. And then this is one thing. I don't know how this has become an interesting stigma in our culture, but I'll read a book or I'll watch an interview with somebody and they'll say, yeah, this person was a former hedge fund manager. What? Okay, if they're so good at what they do and I need to listen to what they say, how come they're a former hedge fund manager? Why aren't they still a hedge fund manager? It's like listening to a former surgeon. It's like, you're not the one that's actually going to do the operating on me. You might have been great in your day, but how's that going to help me? You might give me some useful information, but do I really know that I can trust you? Kind of a thing. And why are you former anyway? Yeah. But they use this as some kind of a selling point. Yeah, coming up, we've got an interview with a guy who's a former hedge fund manager. It's like, okay, what went wrong? How come he's not still doing that? So thank you very much for watching this video. I hope you found it interesting. Please feel free to subscribe to this YouTube channel and leave lots of comments down below. There's also a link to a workshop that I recorded that's freely available to you. Just click on the link in the description. And please feel free to look at some of the other videos that I have links to right here. So I'll see you in the next video.